Hello everyone and welcome to topic 9, inventory and cost of goods sold. So our learning objectives from this would be to understand the concept of what inventory is, what's the relationship between inventory and cost of goods sold, how to account for inventory and cost of goods sold using perpetual as well as periodic inventory system, how to calculate cost of inventory. We will be discussing about the concept of net realizable value. We will also be looking at the gross profit method and the retail method to estimate the inventory. We will look at the financial statement presentation for the same, inventory errors, and finally the comparison between IFRS and ASPE. So what really is inventory then? So inventory is your asset that shows up as current asset onto your balance sheet or statement of financial position. So this is an asset that the business is holding in order to sell and to make money. But keep in mind your inventory can exist in 3 different stages. It can be your raw material inventory, it can be work in process, or it could be finished goods inventory. So the inventories are presented at the present represent a future benefit over which the entity has control or access to. So the primary reason for holding inventory is to sell that to make money. Now, if you remember from our earlier financial accounting courses, every time the inventory account is adjusted, it generally goes with your cost of goods sold account. So how do we calculate cost of goods sold? Is your beginning inventory plus the cost of all the new purchases that we did in the period minus your ending inventory that is still on hand gives us your cost of goods sold. So your cost of goods sold is an item that goes onto your income statement and it will reduce your net income. Okay, so when you're purchasing the inventory, that increases your inventory account. And when you are selling that inventory, you debit your cost of goods sold credit inventory account to bring that asset down. Now, the goods that will be included in the inventory, it really depends on who holds those goods. So one of the determining factors that we do look at is the legal title and possession that will tell you which party should be recording inventory on those on their books. So it depends on who owns those items or who holds the legal title to those inventory items and whether or not that party should be reporting inventory onto their books. Okay, so some of the things, the purchases are usually recognized when the goods are received, but the exceptions to those is your goods in transit, consigned goods, repurchase agreements, and your purchase commitments. Now, recall in the earlier topics, we have discussed the free on board, the FOB shipping point and FOB destination rules and where the inventory belongs. So that is what we will help determine who the inventory belongs to. So this is a quick chart outlining some of the ideas. So if we have goods in transit and those are shipped FOB shipping point, so if it is FOB shipping point, then the legal title belongs to the purchaser because they take possession of the goods as soon as they leave the seller. The possession in transit belongs to the shipping company and have the control or substantially all risk and rewards have passed? The answer is yes. And the party that will recognize the inventory on their books will be the purchaser. With regards to the consignment sale, the legal title always belongs to the consignor, although the possession of the goods is with the consignee. So there is no transfer of risk or rewards. So consignor is the party that will always record these inventory items on their books. When you have sales with a buyback agreement, so this basically is an agreement where the seller is selling something to the buyer and then has an agreement of buying that item back. So it completes the whole circle. So in that instance, the legal title belongs to the purchaser, the possession is with the purchaser, but there is no risk and rewards that have transferred. So this inventory item will be recognized by the vendor. Sales with high rate of return, where returns are estimatable, In that case, the purchaser has the legal title. They also have the possession. The risk and rewards have transferred, and the purchaser will record the inventory on their books. Sales with delayed payment terms where the vendor retains title until considerations are collected, that is bad debt, are estimatable. In that case, the legal title belongs to the vendor, although the possession belongs to the purchaser. The risk and rewards have passed on, so the purchaser will record the inventory. And if we have any purchase commitments which are non-cancelable, then the vendor is the one that has the legal title, the possession, and will record the inventory, although the risk and rewards have not passed. So when we talk about the cost of inventory, what really makes up the cost of inventory? What goes into that number? That is all the cost of purchase, the cost of conversion, and any other cost the business has incurred in order to bring the inventory to present location or to present condition, to a sellable condition. So under IFRS and ASPE, that concept remains the same. So any cost that the business has incurred in order to bring that inventory to present location and sellable condition is your inventoryable cost. So this includes your actual cost of production, the transportation or handling cost that was paid, or any other acquisition cost that the company has paid, which is non-refundable. So any taxes, any duties, anything that the business has paid which is not refundable can become part of your inventory cost. But we do have to keep in mind that there are certain costs which would never be inventory cost, such as the period cost. These are your selling and administrative cost, which can never become part of the inventory cost. The cost of storing the inventory. Now, the general idea is that when the inventory is ready, that is when it is stored. So that is the point. Once your inventory is ready for sale, then all the cost of the inventory stops at that point in time. The storage comes into place after your inventory is ready. So that practically is just a period cost in most cases, unless of course your storage is necessary part of the process. For example, if you have a winery industry, if you're looking at the winery industry, in that case, they need the storage in order for the wine to age, which becomes part of their process. So once it ages, then it becomes a finished goods. So in that case, it could become part of the cost of inventory, but not in general cases. So any abnormal spoilage, wastage of hours, labor, material, all of that production cost is excluded. Any interest cost when the inventories are purchased on delayed payment terms are also excluded. So your product cost is the directly connected with bringing the goods to the place of the business or converting them to the sellable condition, as we said. Now, these includes the asset retirement cost, which must be included under IFRS, any taxes that are not recoverable, and any conversion cost, which is your direct labor fixed cost production. Now, the buying cost is the expenses of a purchasing department, insurance cost, in transit, and handling cost. These usually are not included in the cost of your inventory just because of the cost benefit. Usually these costs are not very great. Um, uh, the cost is not very high, but in order for us to establish that one-to-one relationship, it does cost us more money. Okay, so because of that cost benefit, we don't usually include the buying cost. But if these costs are significant, then possibly they could be included with the cost of inventory. Now, the other issues with the inventory cost are items such as the volume rebates and the borrowing cost. So the volume rebates can be recorded as a reduction of the purchase cost, and it can be recognized before it is received, if and only if the rebate offered is non-discretionary, if it is probable in terms of the rebate will be met, The amount can be reasonably estimated, and the amount of receivable is proportional to the total rebate expected relative to the current level. Okay, so we are including or recording our purchases net of these rebates. Now, the borrowing cost is the cost that the company incurs in order, so when they borrow the money to manufacture that inventory, there is interest attached to those borrowings. So that is what borrowing cost is. So the interest cost incurred to finance these activities that help bring inventories to a condition and place ready for sale. Under the IFRS, the interest cost on any item that can take an extended time to produce or manufacture are product cost. Okay, so such as the winery industry that we were talking about, where the operating cycle is longer, in that case, they do have potential ability to take the borrowing cost as part of their inventory cost. Now, the companies do have a choice between capitalizing and expensing the borrowing cost. Under IFRS, if the financing relates to large quantities produced on a repetitive basis, then they can go ahead and capitalize this or take that as a product cost. Under ASPE, it can be, but if the interest is capitalized, then we need to fully disclose that. The other issues with the inventories are these items listed here. So the standard cost. So predetermined unit cost is based on the cost of the material, labor, and manufacturing overhead when the plant is operating at normal levels of efficiency and capacity. The variances occur when the actual cost is not equal to standard cost. So the standard cost, guys, is a number that is, okay, at the beginning of the year, the companies predetermine the standard cost. Okay, so the standard cost will include the material and labor. Now, material and labor are the fairly easy ones to figure out, but usually the challenge lies with your manufacturing overhead because these are indirect cost. It's fairly time consuming, or the cost benefit comes into play here to actually establish that one-to-one relationship with the manufacturing overhead and the product. So the companies will estimate a standard rate to apply that to the to the inventory. Okay, so that's what they're talking about here. As long as the actual cost is not far out than the standard cost, then that is fine. But if there is unallocated overheads, then that will be expensed in the process. So the services provides the work in process. The work in process inventory is something that is neither raw material nor finished good. This is somewhere in the process, somewhere on your production line. So the cost allocated to the work in process inventory is the material that was incurred on that, the labor, as well as some allocation of overhead cost. Basket acquisition is where the company purchases different types of products or assets with a single price. Now, these goods or assets do have different characteristics. Okay, so in that case, we take the selling price or the purchase price that we have paid for these assets and allocate those to the identifiable assets based on their sales value. So that is proration. Now, when it comes to the inventory system, the level of the inventory we maintain, it does affect your current assets, it affects your net income, your retained earnings, as well as your ratios. Now, think of your journal entries when you're thinking of your inventory account. So when the inventory is purchased, we debit the inventory account and we credit accounts payable, cash, or something, okay, depending on what your situation is. But when these inventory items are sold, at that time, you would debit your cost of goods sold account and you credit your inventory account. So cost of goods sold goes into your income statement and the inventory account goes as current asset onto your balance sheet. So the movement or the management of your inventory is going to affect your income statement as well as your balance sheet. Okay, so The companies need the inventory systems that gives them accurate and up-to-date information. So the companies need to make sure that they have proper internal controls in place to make sure that there are no wastage, breakage, theft, spoilage, missing inventory, or there are any stock outs, they are running out of some inventory types, or they have excessive inventory of certain types. They want to make sure that they haven't overstocked or understocked, because if they have overstocked, then there will be storage and obsolescence issue, theft, so on and so forth. So there is cost associated with overproducing inventory or overbuying them. On the other side, there is cost associated to not having enough either, because then you will miss out on the sales opportunities. So there is cost associated either ways. So the companies want to maintain a optimum amount of inventory at any given point in time. So how are they going to make sure that they have accurate inventory and be able to manage that inventory is through two systems. One is perpetual inventory system, which will track your inventory movement in real time. What's coming in, what's going out. On the other end, there is an option to do this under the periodic inventory system, where the information only is available at the end of the period. Regardless of what measure the company follows, what system the company picks, whether the perpetual system or the periodic system, they still have to do their physical inventory count on regular basis. At the least, they need to maintain it at least once every year. So they have to do a physical inventory count at least once every year. So this is what your inventory systems look like. So as we said, with the perpetual inventory system, this is very real-time information. At any given point in time, the company would know what kind of items, inventory items they have on hand, what was sold, what was the cost of goods sold, what is the ending inventory, what was purchased, what type of items they have on hand. All of that information is available through perpetual inventory system. So this is really very cost-effective method, and it's quite popular and affordable because there are computerized systems that are available to maintain this information. Now, in the back end, in order for the company to know what kind of inventory items they have on hand, the system will use inventory subledgers to maintain different types of inventory items. Okay. On the other hand, your periodic inventory system only gives you the information at the end of the period. So the company will do the physical inventory count at the end of the period, and that is when we calculate your cost of goods sold and inventory that you have on hand. Okay, your purchase returns and allowances are tracked through separate accounts. On the other side, if you thought about your perpetual inventory system, under perpetual system, your purchases, your purchase returns, your purchase discounts, as well as freight in. All of those four types of accounts do become part of the same inventory account, but not under the periodic system. Under the periodic system, all of those four types of accounts are separately maintained. Okay, so the way to calculate your cost of goods sold is your beginning inventory plus purchases minus the ending inventory will give you your cost of goods sold. Now, how do we figure out the cost of the inventory? So the perpetual and periodic inventory system is going to help us determine what inventory items are still on hand and what was sold. But when we say that the inventory movement is going to affect our income statement as well as our balance sheet, what is the total dollar value we are going to allocate? What is the per unit cost allocated to these items? Because perpetual and periodic is only going to tell us the number of items we have in those categories. What type of inventory items we have, it will give you the numbers to that. But what about the cost? What type of cost should be allocating to these items to know what was our cost of goods sold and to know what was our ending inventory on balance sheet? Now, with regards to that, we have three possible options. The company can use the cost formula of specific identification, weighted average, or first in, first out. Now, up until a few years ago, we used to have another fourth option, which was last in, first out. But that option is not an allowable option in Canada anymore. So we don't have to worry about that, but it can be one of these three allowable options. Now, each item purchased or the manufactured is individually identified, as we said. Here, we are looking at different inventory items. So when we are looking at the specific identification method is very, very specific. It is time consuming. It is going to cost you more money. But on the good side, this um, this identification method is really detailed. It will track one-to-one. It will have the item tracked by itself. So every time a new item is purchased and every time the new item is sold, this method will go ahead and account for that. So it's really detailed, will give you the most accurate information. Sorry, quickly before I move forward. So with your specific identification, because there is a higher price tag, you want to make sure that the company does require that method. So usually you will use this in the industry where your products are not homogeneous, something like arts. Okay, so if you have an arts gallery, every art piece has different cost and different selling price. So they are unique. In that case, it would make sense to use the specific identification where each purchase and each sold would be individually tracked. The other alternative is your weighted average cost. So with your weighted average cost and first out, these two methods can be used for homogeneous products where they can be used interchangeably. Okay, so what we do here is we actually, every time the company purchases new items, purchases new inventory, we will calculate the new average cost every time the purchases are made. When the items are sold, we will use the last average cost that was calculated to determine our cost of goods sold. So the good thing about your weighted average cost is it will cancel out any peaks and valleys when it comes to price fluctuations. Because as we said, your inventory movement is going to affect your income statement as well as your balance sheet. So when it affects both, let's say if the prices are changing, the prices of your product is going up, okay, it will give you peaks and valleys. If your product prices are going up, then your cost of goods sold is going to change. So it will create some peaks and valleys with your net income. The businesses usually don't like to see that, and that is why your average cost method in that sense will average out those fluctuations. It will give you an average cost. So the impact onto your cost of goods sold and your ending inventory is going to be averaged out. And then we have our first in, first out method. First in, first out method is assuming that the inventory items that were purchased first were the ones that were sold first as well. Now, when the companies do pick this method, they have to make sure that their physical layout of the warehouse will actually allow the items that were purchased first to be accessed first so that they can be sold first. So whatever came in first is going out first as well. So in this case, we will maintain our purchases separately. So we will follow the first in, first out. This also means that whatever was purchased last is still sitting in your ending inventory if you have any. So your most recent purchases are part of your ending inventory. Okay, so the advantage of this method is that it attempts to approximate the physical flow of the information. That's what we were saying with your warehouse. It has to support that. It needs to have the layout where the items that were purchased first are actually sold first. It does not permit any manipulation of income, and your ending inventory is made up of your most current purchases. On the flip side, your current cost or your cost of goods sold is going to be related to the older cost because it was first in, first out. So if your items were purchased 2 months ago, then that will be reported. Your cost of goods sold will be at the old cost, not at the most current cost. Now, choices of your inventory cost formula. As we said, your last in first out method is not permitted in Canada anymore. That means you are left with specific identification, first in first out, as well as your weighted average cost. So your specific identification is very specific to the industry. It is going to cost you extra money. So we only want to pick this if it makes sense um, in the business environment where each of your inventory item is unique. If it is unique, then go ahead with specific identification. If your inventory items are homogeneous, then go with either first in, first out if your warehouse layout supports that. Otherwise, we can go with average cost. So either of those two methods should work fine. Okay, at the end of the year, when the financial statements are prepared, at that time, we have to make sure that our inventory is not overstated onto the books. Now, keep in mind, guys, when the inventory is recorded onto your books, it is already sitting at cost. Cost is what the company has incurred. So your inventory is already sitting at books, but one last thing we got to check at the end of the year is the LCNRV rule. What that means is lower of cost or net realizable value. So there are two comparing items. One is the cost, which is what your inventory is sitting at right now. The other is your net realizable value. So your net realizable value is your estimated selling price minus your cost to sell. So how much what is the net I would get if I was to sell these items today? We need to make sure that our inventory on the balance sheet, the ending inventory on balance sheet, is sitting at the lower of these two numbers. If your cost is lower, we don't have to do anything because it's already sitting at cost. But should your net realizable value, which is your selling price minus the cost to sell, is lower, then we would have to adjust our books and bring it down. Okay. So what really is NRV, or your net realizable value? So net realizable value is an estimate that changes over time. Okay, now this is also an estimation. Now, if you think of it logically, it really depends on when you're looking at that information. So your inventory may have deteriorated or it could have become obsolete with time. It happens if your inventory has been sitting on the shelves for a long time because the market and the demand changes so quickly. The selling prices can fluctuate because that is tied to supply and demand. So if you are looking in current times with the COVID and the market being slow, it would affect the selling prices. Is there a substitute value that is becoming available? The input cost to complete and sell, liquidate, or dispose your product can also change depending on the condition and the market that we are selling in. Okay, let's say in the older times, you could just sell the product as is where is. But with the COVID, you could see the change where you are pressurized to deliver the items to your buyers as well. Okay, not just the sale, but the sales and the transportation. So that is going to be additional cost. So net realizable value, then we got to understand, is an estimated number. It keeps changing. It really depends on the market, supply and demand, what kind of products you have, so on and so forth. So there are quite some moving and variable pieces in that. So we need to determine that the most likely net realizable value at the end of each accounting period, given given the specific circumstances. A new estimate is required for each set of financial statement, and being an estimate, NRV is subject to manipulation. Okay. So when we are applying our NC NRV, it's usually applied to changes in the value that occurs in the normal course of business. Okay, so we want to make sure that our inventory and our net income are not overstated. Because again, when we are adjusting, your inventory is already sitting at cost. And if you do have to bring it down further, it is going to affect your income statement as well as your balance sheet. So we want to make sure that our asset and income are not overstated or understated. We want to have a picture that is closer to the reality. Okay. Now, the grouping is allowed for the products if they are closely related in terms of the end use, are produced and marketed in the same geographical area, and they cannot be evaluated separately in practical or reasonable ways. And sometimes grouping can affect the amount of the income reported as well. Now, generally speaking, the LCNRV rule has to be applied on item by item basis. You can only group them if they are homogeneous products. Okay. Otherwise, the LCNRV, we are not, let's say if we have 10 different types of inventory items, we cannot apply the LCNRV rule to the totals of these 10 inventory items you have. You have to apply it for each inventory type, unless of course your product is homogeneous and they can be grouped together. Okay, so that is what they were talking about here under the grouping and when that is allowed. So the two ways we can adjust for your LCNRV is through a direct and an indirect, or the allowance method. Now, direct method is the one that is most commonly used, where we just take the difference. If your cost is higher than net realizable value, we take the difference in those two, debit cost of goods sold, and credit our inventory account, and off we go. Okay, the alternative method is your the indirect method, also called as your allowance method. Now this is slightly different. So with this method, we are setting up an allowance account to credit the inventory. So under the direct method, you directly brought down your inventory account. Under the allowance or indirect method, we are not touching that inventory account directly, but we are setting up an allowance account for the inventory, which will work as a contra account, will give you the same impact. It's just how we would account for it. So we will credit an allowance account to reduce the inventory to net realizable value, and we would debit a loss account, not the cost of goods sold. Regardless whether the company follows the direct or the indirect method, the impact onto your financial statements is going to be the same. Cost of goods sold goes to your income statement, so would the loss on inventory account. Inventory account goes to balance sheet, and so does the allowance for inventory account. So the effect on your income statement is going to be the same, but when we set up the allowance method, that gives the users more information, because your write down is not is blanketed into your cost of goods sold. It's kept separate, so your user knows where those numbers are coming from and that your inventory was written down. When you combine it into your cost of goods sold, the user cannot tell. Okay, when the numbers are hidden in cost of goods sold for the inventory write down, then the user cannot tell that information because it's all into one account. So use of allowance account will give user that information. So it's more transparent. It will tell them that this is the amount written off because of LCNRV. So gives better information. That's why it is used. Now, the other thing to keep in mind with the LCNRV is any previous losses can be recovered but up until the original amount only. You can never overdo it. Okay, so in the example that we were looking at, our write down under the LCNRV was $12,000. So if in the following period the amount of inventory goes up, then we can go ahead and recover, but only up until that $12,000, nothing more than that. All right, so up until now, we have talked about how to account for our inventory, that is through perpetual and periodic inventory system, and how to allocate cost to the inventory, which was your specific identification, first in, first out, and weighted average. What we are looking at here is the second half of our topic, which is measuring our inventory using estimates. Now, when we are taking a physical inventory, remember, we said the businesses need to take the physical inventory at least once a year. Now, for certain businesses or certain situation, it can become rather hard to do the physical inventory count just because you can't or it's impractical. So in that cases, in those circumstances, we end up estimating the inventory on hand. So these are the estimation methods that we will use. So only an estimation is needed, and we can use this for the interim reports, and they have reasonable testing. The inventory, now when we would use these estimates is, let's say if the inventory was destroyed in a fire, you cannot go back and count anything because it's destroyed. Okay, your last inventory count was done quite a while ago, so you don't know. In that case, we will end up estimating that, and that is an acceptable method of doing that. Okay, it provides you a rough check on the accuracy of the physical count. So these numbers are not accurate, but they are quite close to that. So the two methods that we do end up using for estimating our inventory is the gross profit method and the retail inventory method. So the gross profit method, this is based on three primary premises. One is that your beginning inventory that was purchased is equals the cost of goods available for sale. So remember, when we were talking about the cost of goods sold formula, we said beginning inventory plus new purchases gives us our cost of goods available for sale, minus ending inventory gives us our cost of goods sold. Okay, so under gross profit method, we are believing it's based on the fact that your beginning inventory plus purchases is equal to your cost of goods available for sale. And that cost of goods available for sale minus the estimated cost of goods sold will give you your ending inventory. Okay, and the cost of the goods not in the cost of goods sold must be in the ending inventory. So this is just basically the logic behind it. Okay, we are working with the same formula, depends on what you're trying to estimate here. So here we are trying to estimate our ending inventory. With that same formula, beginning inventory plus purchases minus ending inventory, we were working at cost of goods sold. So the same formula can be used for determining ending inventory. So with the gross profit percent of the selling price is favored over the percent of the markup cost. Now most goods are stated at on their retail basis, not on cost. Now the perception is that the percentage of selling price is lower than the percent of cost, and the gross profit is based on the selling price that cannot be greater than 100%. And this probably makes a little bit more sense when we are looking at the actual numbers. So we will be exploring this further when we are discussing the concepts or the questions in class together. So on the flip side then, with the gross profit method, this provides an estimate only. It uses the past percentages, and the biggest disadvantage is that it uses a single gross profit rate that may not be appropriate for all inventory items. So your gross profit method is not normally accepted for financial reporting purposes. It's only a physical count is needed, but it is used to estimate ending inventory in interim reports and for insurance purposes only. This is the only time the gross profit method is acceptable. For financial reporting purposes, we cannot use that. So on the other hand, we have our retail inventory method. Now, this method is quite popular and is used in the retail environment. Now, if you think of your retail stores, the way the inventory moves, there is so much movement with the inventory, it practically becomes hard to take your physical count because there are so frequent changes. Okay, so that's where we use our retail inventory method. So we are accounting for inventory in the retail operations present several challenges because it is difficult to use specific identification for high volume, low cost products. It's difficult to determine the cost of each sale and to reflect decline in the value of merchandise. And it is also difficult to allocate cost such as transportation. An alternative in those cases to overcome these difficulties is to estimate your inventory cost by taking a physical inventory at retail price. So we will be using the periodic inventory counts to capture the lost or stolen items. We are not replacing the physical counts. We will be looking at differences between the records and the physical count that is required as an adjustment. So your retail inventory method is based on observable patterns between cost and selling price, and we call that as cost to retail ratio. So the retail inventory method is going to require the total cost and the retail value of the goods purchased. So here we will be comparing the cost of purchases and the retail value of those purchases. The cost and the retail values of goods that are available for sale, as well as the sales that were made in the period. Now, these records are maintained by the business. Sales are deducted from the retail value of the goods available for sale, and the result is the ending inventory at retail value. Then the ending inventory at retail value is converted to cost using the cost to retail ratio. So there are two pieces here. One is we calculate the cost to retail ratio, then we calculate the ending inventory at retail, and then we backtrack by multiplying those two to calculate our ending inventory at cost. Because remember, what sits onto our financial statements when it comes to inventory is at cost, not at retail. So this is a back calculation. And as I said, once again, once we are actually looking at the numbers, these things tends to make more sense. So with the retail inventory method, the complications that we have is the items affecting purchase cost. So there is freight costs that are treated as part of the purchase cost, your purchase return, purchase allowance, and purchase discounts that are also part of your purchases. So we will take net purchases. So total purchase minus purchase return, purchase allowance, and purchase discount. The sales returns and allowances are treated as adjustment to gross sales. Okay, now purchases are different than sales. Purchases are taken as net, which is include the freight cost and take net purchase. So purchase minus the contra accounts, which is purchase returns, purchase allowance, and purchase discount. But the sales return, sales allowance, and sales discount are part of the sales transactions. So the other complicating factor there are the transfer ins, your normal shortages, abnormal shortages, and employee discounts. When it comes to disclosure on the inventories, there is quite some extensive disclosure requirements. And the reason why there is so much and so many rules, regulations, and so many different ways of doing things under inventory, guys, think of it on a very conceptual or a basic level. Inventory actually can make up a very big percent of your total current assets. Okay. In my context, it can be good 60 to 70% of our total asset account. because of that high weightage attached to the inventory single account, there is so many rules and regulations of what can be done and what can't be done, because it is susceptible to manipulation. So when it comes to inventory disclosure, we have to disclose the measurement policies. How was your inventory measured? What policies did we use? Are we using perpetual, periodic? What cost assumptions are we using? Did we do LCNRV? Did we apply that on item by item basis or total basis? Was there any recovery of LCNRV that is accounted for? Are there inventory items that are pledged as securities? Okay, you can also have the inventory that is pledged. Are there any strings attached to that? So all of that items, all of those disclosure goes to your notes to your financial statements. The additional disclosures for inventory under IFRS is the carrying amount of inventory carried at fair value minus cost to sell, your details of inventory write-downs and reversals of those write-downs, and the reconciliation of balances for biological asset, agriculture products, and points of harvest. That last point is very specific to those kind of industry. One last thing we have to discuss here, my friends, is your inventory errors. Now, remember, on and off, we kept saying that your inventory affects two accounts. One is your cost of goods sold, and other is your inventory. Okay, so your inventory movement affects your income statement through cost of goods sold account, and your ending your ending inventory on your current assets, which sits onto your balance sheet or SFP. So if there are any inventory errors, those inventory errors are going to affect your income statement as well as your balance sheet. Now, cost of goods sold is an implied expense. If that expense is overstated or understated, it is going to have the effect on your income statement, and that income statement is flushed through retained earnings. So ultimately, any overstatement or understatement of your inventory account is going to affect your cost of goods sold, which eventually will hit retained earnings. So your asset account is going to be overstated or understated, as well as your retained earnings is going to be out. Now, what causes these inventory errors is if the inventory was not correctly counted, or if we haven't correctly accounted for the inventory based on the ownership. Let's say there was inventory in transit that, let's say it was FOB shipping point, and we were the purchaser, we were the buyer. That's when it becomes our inventory. So if it was FOB shipping point, the buyer should have accounted for inventory on their books. But let's say they never did because the inventory was physically not present at the location. Okay, so if they missed accounting for that inventory, that becomes then the inventory error. So omitting the inventory items in the ending inventory, not recording purchases, but counting it in the inventory, not recording a sale in the current period, although the item has been delivered, and failing to adjust the inventory to lower of cost of net realizable value. So if any of those things happen, they are going to throw your cost of goods sold and your ending inventory out. Okay, so again, the ending inventory, so there will be two pieces of impact. One is your retained earnings. So when we adjust our retained earnings has to be adjusted net of income tax. Okay, especially if you're doing the prior period adjustments, the prior period adjustments have to be adjusted net of income tax. And when you think of your inventory account is a balance sheet account, which is a permanent account. So the balance in that account goes from one year to the other. So your beginning inventory will become ending for the next period. So I have reflected a quick chart up there on the top right corner to know what the impact on cost of goods sold for overstated and understated inventory will be. And lastly, this is our comparison between IFRS and ASPE with regards to the coverage that we have discussed. So that is all I have for this particular topic, guys. Thank you for listening in.